Hey, everyone! I'm just one person, hidden deep in the countryside, surrounded by silence. But I built BlockSonic to speak with the entire world. Here, you don't get noise, you get the pulse of Bitcoin, every single day, distilled into pure, essential updates. No teams, no sponsors, no filters. Just me, a signal from the quietest place on Earth, bringing you the most important Bitcoin news before the world wakes up. With BlockSonic, you don't need to search for information. I research, I write, and I tell the story behind every headline. I do the digging. I chase the truth. All you have to do is listen. Today, the news dives into Bitcoin's struggle amidst shifting yields sparking a wave of capital flight. We'll explore how Bitcoin, once a beacon in volatile markets, now finds itself trailing behind gold as it loses ground while the yen rallies. As traders shift focus to traditional safe haven assets, Bitcoin's resilience is tested, sitting below $88,000. Meanwhile, gold shines brightly, surpassing $5,000 per ounce for the first time. Join us as we unravel these intricate market dynamics, discuss the implications of Japan's economic maneuvers, and anticipate the Federal Reserve's next steps. Plus, we'll look into how these developments shape investor sentiment and impact strategic moves within the financial landscape. Stay with us for insightful analysis and expert perspectives on this unfolding financial drama. Bitcoin's escapade in the shadow of gold's ascent. Our gaze into the unfolding economic landscape for January 26, 2026. In recent days, we have observed Bitcoin's struggle to find firm footing as concerns over the yen's strength and fiscal uncertainty have led to a divergence between cryptocurrency and traditional safe haven assets. Bitcoin experienced a 0.8% decline over the past 24 hours, now trading below $88,000, while Ethereum saw a more significant drop of over 1.6%, settling just under $2,900. The broader index, akin to a barometer for cryptocurrencies standing, fell by 1.54%. Concurrently, the yen surged by more than 1.4% against the dollar following a declaration from Prime Minister Sani Takaichi that Japan would undertake all necessary measures to counteract speculative and abnormal market behaviors. Although Takaichi refrained from specifying which market movements were concerning, it is noteworthy that yields on Japan's 10-year bonds recently reached a 27-year high, before experiencing a slight decrease. Traders are interpreting a recent rate check by the Federal Reserve Bank of New York as a possible indication of coordinated action with Japan, a scenario causing investors to withdraw from riskier assets as the yen carry trade unwinds. Investor Michael Burry, known for his foresight during the subprime mortgage crisis, highlighted the narrowing gap between Japanese bond yields and global rates, suggesting that repatriation is pending. This implies that nearly $5 trillion of overseas investments, predominantly in the United States, may be retracted to capitalize on these yields. Consequently, capital has exited risk assets in anticipation of such a shift. The Nikkei 225 index fell by 1.8%, while futures for the Nasdaq and S&P 500 declined. Curiously, this capital has not flowed into Bitcoin, but rather into gold, which surpassed $5,000 per ounce today, reaching $5,090. The ever-present nature of Bitcoin, coupled with its deep liquidity and instant settlement features, may be hindering its performance, as noted by Greg Cipollaro, Global Head of Research at NYDIG. During times of stress and uncertainty, liquidity preference prevails, and this dynamic adversely affects Bitcoin far more than gold, Cipollaro remarked in a note. Blockchain data further suggests internal fragility. A report from CryptoQuant indicates that long-term Bitcoin holders are selling at a loss for the first time since October 2023. Attention will turn to this week's Federal Reserve meeting, where interest rates are expected to remain unchanged. However, guidance from Chair Jerome Powell will be pivotal. Additionally, the risk of a United States government shutdown, currently estimated at 79% on Polymarket and near 78% on Kalshi, adds another layer of uncertainty as major tech firms prepare to report earnings and provide guidance. Remain vigilant. In light of these developments, we are reminded of the ever-present tension between the allure of decentralized digital assets and the security of traditional stores of value like gold. The question we must ponder is, in an era of fiscal uncertainty and market volatility, which path will yield the greatest harmony between risk and reward? We invite you to share your thoughts and join the discussion in the chat. Bitcoin's resilience amid winter's wrath. The storm's gale tested Bitcoin's backbone, yet markets remain unwavering, revealing hidden truths about decentralized strength. A fierce winter storm in the United States tested the resilience of the Bitcoin network, as the hash rate experienced a 10% decline on Sunday. This event underscores a critical issue often highlighted by scholars. The centralization of Bitcoin mining has transformed isolated infrastructure failures into risks that can echo through the entire system. The hash rate is a crucial measure of the computational power used to process transactions and maintain the Bitcoin blockchain. A significant drop in this metric means fewer transactions can be processed, potentially causing delays until the network adjusts its difficulty level. Despite the storm, the Bitcoin network continued to operate, with only 10% of its hash rate affected. However, scholarly research has been shedding light on the growing vulnerability of Bitcoin to such disruptions. A noteworthy study, titled Bitcoin Blackout: Proof of Work and the Risks of Mining Centralization by Philip Charnofsky and Jiahua Shi, examined a similar occurrence in China in 2021, where a regional mining failure led to increased block times, higher transaction fees, and diminished market quality. This research illustrates how concentrated mining operations can turn local outages into widespread network disruptions. The increasing concentration in Bitcoin mining is a matter of concern, as block production is predominantly controlled by a few dominant pools. The Mining Centralization Index reveals that a small number of pools currently dominate block production, thereby diminishing the network's ability to withstand localized disturbances. In recent years, the top two mining pools have consistently controlled over 50% of Bitcoin's hash rate, while the top 6 pools account for approximately 80 to 90% of block production. This concentration places the majority of transaction processing power in the hands of a few operators, creating a potential single point of failure. Interestingly, despite the apparent risks, markets have shown little reaction, with Bitcoin's price remaining stable. This episode highlights the paradox of how the growing concentration in Bitcoin mining can transform physical infrastructure failures into systemic stresses without immediately impacting the currency's value. Reflecting upon this, we must ask ourselves, how can the Bitcoin network ensure its resilience against future localized disruptions without sacrificing its decentralized ethos? We invite you to share your thoughts and join the discussion in the chat. If you believe in what we're doing and want to support BlockSonic's growth, just scan the QR code on the screen or copy the link in the description. Every contribution makes a difference and helps us keep delivering quality, independent, and up-to-date content for you. Unprecedented Bitcoin decline threatens market stability. The looming possibility of Bitcoin's 4th consecutive monthly downturn raises concerns amidst upcoming options expiry. Bitcoin appears poised to record a 4th consecutive monthly decline, an occurrence not seen since the period from 2018 to 2019, which saw 6 successive months of losses. With one full trading week remaining in January, Bitcoin's value hovers just below $87,000. The asset experienced negative monthly closures in October, November, and December, marking a significant correction from its October peak. From its highest point to the lowest, Bitcoin has seen a decline of approximately 36% during this time frame. Interestingly, even during the bear market of 2022, when Bitcoin plummeted from $69,000 to $15,000 amid monetary tightening and industry-specific setbacks, it did not witness more than 3 consecutive monthly declines. This historical context underscores the rarity of the current trend if January ends on a negative note. Despite spot price weakness, derivatives markets reveal a glimmer of cautious optimism. Data from Deribit indicates that options positioning suggests some modest potential for an upward movement as the month concludes. Bitcoin faces an options expiry on January 30th, with total open interest nearing $8.5 billion on Deribit. The $100,000 call option holds the highest nominal value, approaching $900 million, suggesting that a significant group of traders is betting on a recovery to the six-figure mark. The max pain price for this expiry is close to $90,000, which refers to the level where the majority of options contracts expire worthless, potentially exerting a gravitational pull toward that price as expiration nears. As we reflect upon these unfolding events, we must consider the underlying forces at play. Are we witnessing the natural ebb and flow of market dynamics? Or does this signify deeper systemic issues? The Austrian perspective reminds us that market signals are inherently the result of voluntary choices and decentralized knowledge, and thus, the current scenario could be an instance of the market's self-correcting mechanism in action. However, we must remain vigilant to the potential distortions introduced by external interventions and artificial constraints. What is your interpretation of Bitcoin's current trajectory? We invite you to share your thoughts and engage with us in the discussion below. Bitcoin surges amid market turbulence. Crypto's daring comeback. Bitcoin skyrockets from market depths, but uncertainty looms as investors seek stability in traditional assets. Bitcoin, valued at $87,776, mounted a recovery after plummeting to $86,000, its lowest point in over a month on Sunday. This resurgence coincided with the commencement of Bitcoin futures trading on the Chicago Mercantile Exchange at 2300 Coordinated Universal Time. The preeminent cryptocurrency experienced a more than 2% rise over the ensuing 9 hours, before encountering resistance at $88,250. In a broader view, Bitcoin persists in a taxing decline marked by a succession of lower highs and lower lows initiated in October, sketching the outlines of an incipient bear market reversal. Sunday's downturn was driven by investors' continued withdrawal from risk amid a tumultuous week, highlighted by the United States President Donald Trump's speeches in Davos concerning Greenland, tariffs, and geopolitical tensions globally. This risk-averse sentiment elevated precious metals like gold and silver to unprecedented highs, undermining Bitcoin's standing as a safe haven and aligning it more closely with U.S. equities as a risk asset. Reflecting on these developments, we see the intricate dance between perceived safe havens and risk assets, revealing the complexity of market perceptions and the dynamic interplay of global events. As Bitcoin oscillates between being a refuge and a risk, we must ponder the pathways open to those who dare to navigate this evolving financial landscape. How do we, as participants in this ever-changing market, perceive the shifting role of Bitcoin amidst traditional assets? Share your thoughts and join the conversation in the chat. And don't forget to subscribe to the channel, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. Bitcoin profits propel Metaplanet's revenue forecast to new heights. Metaplanet, anticipates revenue exceeding $100 million in 2026, with 97.5% stemming from Bitcoin ventures. Metaplanet, a Tokyo-listed enterprise, is poised for a substantial revenue surge this year, following a tumultuous conclusion to 2025 marked by a substantial paper loss due to Bitcoin's steep correction. The company has adjusted its full-year forecast for fiscal year 2025 and unveiled its outlook for fiscal year 2026, highlighting significant growth in operating income and sales, largely driven by its burgeoning Bitcoin income generation business. This business segment leverages the company's substantial Bitcoin holdings, valued at over $3 billion, as collateral for generating revenue through structured option strategies. The firm credits its success partly to the issuance of Class B, perpetual preferred equity, Mercury, and establishing a $500 million credit facility, reducing its capital structure's reliance on share price fluctuations. Additionally, the introduction of a senior class of preferred share (MARS) has bolstered its financial stability. For fiscal year 2025, revenue reached 8.9 billion yen, a 31% increase from prior forecasts, while operating income climbed 34% to 6.3 billion yen. Nevertheless, a 104.6 billion yen write-down on Bitcoin holdings in the fourth quarter resulted in an ordinary loss of 98.6 billion yen and a net loss of 76.6 billion yen. Despite these accounting setbacks, Metaplanet asserts that cash flows and business fundamentals remain unaffected. The company's Bitcoin yield, reflecting the growth in Bitcoin holdings per share, soared by 568% over the year, even amid share dilution. Looking forward, Metaplanet projects 16 billion yen in revenue and 11.4 billion yen in operating income for fiscal year 2026, predominantly fueled by Bitcoin-related activities. 97.5% of anticipated sales are expected from this segment, with the remaining 400 million yen attributed to its stable hotel business. Although Metaplanet has not provided guidance for net income in 2026 due to Bitcoin price volatility, it emphasizes that its Bitcoin strategy, encompassing acquisition and yield generation, remains steadfast. Reflecting on these developments, we recognize the inherent uncertainty and risk associated with a strategy heavily reliant on volatile assets like Bitcoin. While the potential for substantial gains exists, so too does the possibility of significant losses. As we consider Metaplanet's approach, we must ponder the broader implications of such strategies on long-term economic stability and sustainability. What are your thoughts on the potential risks and rewards of relying heavily on volatile assets like Bitcoin for revenue generation? We invite you to share your insights and join the conversation in the chat. Bitcoin's intricate dance amid market uncertainty. The ongoing saga of Bitcoin's price fluctuations highlights key zones of potential support and resistance, suggesting pivotal shifts ahead. Bitcoin's recent price journey has traversed a complex landscape, with values dipping to $86,000 as CME futures resumed after a weekend pause. Despite a slight recovery, the market narrative remains entrenched in a downward trajectory. This movement has unveiled a pricing gap reaching up to $89,265, a phenomenon typical when Bitcoin's spot price shifts while CME futures are inactive. Historically, Bitcoin has a pattern of revisiting such gaps, hinting at possible future movements. Reflecting on the past, Bitcoin's last all-time high occurred on October 6th, 111 days ago, with the current price approximately 30% lower, underscoring the bearish sentiment. Should Bitcoin breach the $80,000 mark, it could potentially revisit levels from April 2025, marked by a low of $76,000 during a sell-off linked to tariff policies. Currently, the 100-week moving average serves as a critical support level, representing a long-term structural indicator. Since reaching a local low on November 21st at $80,000, this level, now near $87,145, has consistently held. Bitcoin has also fallen below the 50-day moving average of just over $90,000, an indicator often used to assess short-term trends. Beneath the present level, several support zones are noteworthy. The difficulty regression model, which estimates Bitcoin's average production cost based on mining difficulty, is near $89,300. Commodities often gravitate towards or dip below their production cost during bear markets. Further, the aggregate cost basis for United States spot Bitcoin exchange-traded fund buyers stands at $84,099, a level that has provided support for several months. On-chain data reveals the 2024 average exchange withdrawal price as $82,713. Base. Finally, the true market mean price, derived from dividing the investor cap by active supply, is just above $80,000, aligning closely with the November low and reinforcing its significance as a potential mean reversion level. In light of these observations, we are reminded of the delicate balance between market forces and the decentralized nature of Bitcoin. How does this intricate dance of prices and support zones influence your view of Bitcoin's future path? We invite you to share your thoughts and engage with us in this ongoing discourse. And don't forget to subscribe to the channel, like, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. Strategic moves amidst cryptocurrency ebb. ARK Invest's bold acquisitions. ARK Invest's proactive acquisition strategy unfolds as it seizes significant stakes in cryptocurrency companies amidst market downturns. ARK Invest has taken decisive action by acquiring a noteworthy sum of $21.5 million in shares from Coinbase, Circle Internet, and Bullish. This marks the firm's first engagement with these stocks since mid-December, signaling a strategic move. Guided by the insightful Cathie Wood, ARK Invest has expanded its influence within the realms of innovation through its funds, namely innovation and blockchain and fintech innovation, exchange-traded funds. The firm strategically acquired 129,446 shares of the stablecoin innovator Circle, valued at $9.2 million. Maintaining stability despite a 10% decline during the week. In addition, ARK Invest procured 42,179 shares of the cryptocurrency exchange Coinbase and 88,533 shares in Bullish, the entity behind CoinDesk. These investments were valued at $9.15 million and $3.17 million. Respectively, amid modest decreases of 2.77% and 2%. The cryptocurrency market exhibited bearish tendencies last week, with Bitcoin experiencing a near 6% reduction, descending below the $90,000 threshold. ARK Invest's enduring strategy embraces equity price reductions, capitalizing on multi-day downturns to uncover greater value. This approach underscores the importance of seizing opportunities amidst market fluctuations. In reflection, we ponder the role of opportunistic strategies within volatile markets. Do such calculated maneuvers truly harness the potential of unexpected market shifts? We invite you to share your thoughts and engage in this discourse in the chat. Gold Ascent and Bitcoin Stagnation. Navigating market divergence. A dramatic shift unfolds as gold surges past $5,000, while Bitcoin lingers near $87,000, revealing a deepening divide in market dynamics. In the unfolding tapestry of global markets, gold's ascent past $5,000 reflects a profound realignment, contrasting sharply with Bitcoin's stalled trajectory near $87,000. As we witness this divergence, the underlying currents suggest a broader narrative of market forces and individual actions guiding these paths. As we embark on this journey through the intricacies of the economic landscape, gold's recent climb above $5,000 heralds more than a mere fluctuation. It signals a potential shift in the macroeconomic regime, underscored by geopolitical tensions, sustained central bank acquisitions, and the waning influence of the United States dollar. This flight to the yellow metal illustrates a collective quest for stability amidst uncertainty. In stark contrast, Bitcoin's journey tells a tale of internal market mechanics. On-chain data indicates a market grappling with supply overhang and tepid participation. A pattern emerges. Seasoned holders liquidate at losses, giving way to newer entrants, suggesting consolidation rather than momentum. The market struggles against a dense supply ceiling, with rallies repeatedly thwarted by sell pressures at pivotal thresholds. Options markets echo this sentiment, signaling persistent strength in gold, while expectations for a near-term Bitcoin revival wane. The digital currency remains tethered below critical short-term holder cost bases, ensnared by a formidable supply barrier just beyond $100,000. Recent rallies, though promising, falter against entrenched resistance, underscoring the fragility of upward movements. Market dynamics reinforce this narrative. Compressed futures volumes, subdued leverage, and thin liquidity paint a picture of a market in digestion mode, absorbing internal supply rather than responding to external stimuli. Polymarket traders lean towards gold, maintaining its newfound strength, while Bitcoin faces further consolidation. In this evolving landscape, gold emerges as a beacon of resilience, absorbing macroeconomic stressors, while Bitcoin navigates its cyclical journey. As we ponder these developments, we must ask, in a world of spontaneous order and individual choice, how do we perceive the balance between stability and innovation? Share your thoughts and join the conversation in the chat. And don't forget to subscribe to the channel, like, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. Innovative equity maneuver could transform debt management. A groundbreaking financial strategy might reshape debt management for firms with substantial obligations, offering a fresh perspective on long-term financial stability. An intriguing development within the realm of financial management sees a prominent Bitcoin treasury and asset management firm turning to perpetual preferred equity to retire convertible debt. This approach not only restructures the balance sheet, but also sets a potential precedent for other companies with significant debt burdens. Recently, the firm strategically priced its variable rate series, a perpetual preferred stock, at $90 per share. This offering exceeded the initial $150 million target, allowing for the issuance of up to 2,250,000 shares, blending public issuance with privately negotiated debt exchanges. The organization aims to leverage the net proceeds to address existing convertible notes due in 2030, guaranteed by the firm. Notably, exchange agreements with certain note holders holding $90 million in aggregate principal have been arranged. Approximately 930,000 newly issued shares will be exchanged directly for these convertibles. Rather than opting for traditional refinancing, the company is transforming fixed maturity obligations into perpetual preferreds. These carry a variable dividend set at 12.25% and lack a maturity or conversion feature, thus enhancing leverage metrics and flexibility. Bondholders, in exchange for a higher-yielding instrument that supersedes common stock, forfeit equity conversion options. This innovative strategy could serve as a blueprint for other enterprises, such as Strategy, which faces approximately $8.3 billion in outstanding convertible notes. Its perpetual preferred securities have recently surpassed convertibles in notional value, with significant tranches due in the future. Exploring the use of preferred equity to retire such debts provides executive leadership, like that of Michael Saylor, with an additional tool to mitigate future maturity risk. Reflecting on this financial maneuver, we observe a profound shift in how firms can manage leverage and risk. By embracing perpetual preferred equity, companies can achieve greater financial flexibility, potentially sparking a wider adoption of this strategy in the corporate world. How might this approach influence the broader economic landscape and reshape the way we perceive debt management? We invite you to share your thoughts and join the dialogue in the chat. Bitcoin's tumultuous ride amid economic uncertainty and anticipated rate decisions. Bitcoin and major digital tokens faced volatility as markets braced for the Federal Reserve's upcoming rate decision, amidst political tensions and economic uncertainty. Bitcoin dipped below $88,000 on Sunday, reflecting a market grappling with uncertainty and thin trading over the weekend. This decline extended a trend seen over the past week, impacting the broader digital currency landscape. Bitcoin traded around $87,800 during U.S. afternoon hours, marking a decrease of approximately 2% over 24 hours. Ether approached $2,880, with Solana, XRP, and Cardano each experiencing losses between 3 and 5%. This pattern of decline across major tokens over the past week underscores prevailing market fragility. This market movement triggered $224 million in liquidations on bullish bets within the past 24 hours. Bitcoin-tracked futures led the way with $68 million, followed by $45 million in Ether-based futures, as reported by CoinGlass data. Weekend market shifts often reflect strategic positioning rather than new information, especially following periods of heightened volatility observed earlier in the week. Traders approach the new week with heightened vigilance, anticipating potential interventions in the Japanese yen. Prime Minister Zanai Takaichi's warning against abnormal market movements follows a sudden reversal in the yen late on Friday, raising caution across Asian trading desks despite no official confirmation of action, as noted by Bloomberg. Meanwhile, political risks in the United States contribute to an already unstable situation. Senate Democratic leader Chuck Schumer's announcement to block a significant spending package unless it excludes funding for the Department of Homeland Security increases the likelihood of a partial government shutdown. Such standoffs, though familiar, can tighten liquidity conditions and affect sentiment across risk assets during periods of elevated positioning. Historically, Bitcoin has experienced selling pressure leading into potential government shutdowns, followed by subsequent rallies. Currently, polymarket traders assess a 76% chance of a U.S. government shutdown by the month's end. Looking ahead, investors focus on a busy earnings week featuring results from several major technology firms, including Microsoft, Meta Tesla, and Apple, collectively known as the Magnificent Seven tech giants. Traders will closely monitor these companies' earnings for insights into artificial intelligence trends, potentially impacting market sentiment. Additionally, the Federal Reserve's forthcoming rate decision is keenly anticipated by traders. Although the Fed is expected to maintain rates during its upcoming meeting, market participants will pay close attention to Chairman Jerome Powell's post-meeting remarks, which could influence Bitcoin and other asset classes. As we reflect on these events, we must ponder the deeper implications of economic uncertainty and market responses. How do we navigate the intricate dance between market dynamics and external interventions? We invite you to share your thoughts and engage in the discussion in the chat. And don't forget to subscribe to the channel, share with your friends, and participate in the chat. These simple actions really help the project grow and keep BlockSonic running at full speed every day. Anticipation and uncertainty. Will the Fed's decision shake the dollar and Bitcoin? Will Powell's remarks ignite market volatility? The forthcoming decision from the Federal Reserve holds the potential to sway both traditional and crypto markets as the financial world awaits Chairman Jerome Powell's post-meeting insights. The Federal Reserve stands poised to announce its upcoming rate decision with a prevailing expectation that rates will remain unchanged. However, the spotlight will truly be on Chairman Jerome Powell's press conference, where his insights on future monetary policy and pressing economic topics may significantly influence both traditional and crypto markets. Recent actions by the Federal Reserve, including 3 consecutive quarter-point rate reductions, have set the stage for a likely pause in rate cuts. As of the latest data, CME's FedWatch suggests a 96% probability of rates holding steady between 3.5 and 3.75%. This aligns with Powell's previous statements from December, indicating a temporary halt to further rate reductions into the year 2026. Minneapolis Federal Reserve President Neil Kashkari has also expressed caution, emphasizing that it is way too soon to consider additional rate cuts. The primary consideration for traders centers on whether this pause signifies a hawkish or dovish stance. A hawkish pause could involve Powell highlighting persistent inflation concerns, potentially dampening expectations for future rate cuts and exerting downward pressure on risk assets. Conversely, a dovish pause might suggest a temporary halt, followed by resumed rate cuts in the near future, potentially benefiting Bitcoin. Morgan Stanley anticipates a dovish signal through the retention of policy statement language, hinting at further adjustments to the target range. This statement may acknowledge the economy's resilience while preserving flexibility for future rate cuts. Attention will also be on potential dissenters to the Federal Reserve's decision, as any increase in dissent could strengthen the case for future easing, benefiting stocks and Bitcoin. Most observers, except J.P. Morgan, anticipate rate cuts later this year, while J.P. Morgan expects no rate changes this year, followed by a potential hike next year. Powell will likely face inquiries regarding the rationale for maintaining current rates, as well as the impact of recent affordability measures on key macroeconomic variables. According to Ian, Powell's explanation of the decision to maintain current rates may bolster the U.S. dollar, potentially weakening assets denominated in greenbacks, like Bitcoin. Recent U.S. asset market performance and economic activity may challenge Powell's ability to justify the need for looser financial conditions, potentially diminishing prospects for a second Federal Reserve rate cut and strengthening the dollar against low-yield currencies like the yen and the euro. Powell's potential acknowledgement of recent housing affordability measures as potentially inflationary in the short term could heighten market volatility. Recent policy actions aimed at influencing mortgage rates and institutional investors may impact housing inflation dynamics. As we consider these developments, we must reflect on the broader implications of centralized monetary interventions and their potential unintended consequences. How do we balance the need for economic stability with the principles of individual choice and market-driven coordination? We invite you to share your thoughts and join the conversation in the chat. Cryptocurrency fortunes. Unleashing luxury through decentralized lending. The wealthy elite are revolutionizing their lifestyle enhancement by leveraging decentralized finance to secure loans against their burgeoning cryptocurrency holdings, circumventing traditional financial limitations. Imagine a scenario where an individual possesses a residence in Switzerland and a beachfront property in Miami, valued collectively at $10 million. Their immediate desire is to access a line of credit for indulgences such as skiing in St. Moritz, attending the Cannes Film Festival, and upgrading their luxury yacht. In conventional financial systems, they might approach their bank to use these assets as collateral for a short-term, flexible loan. However, when a significant portion of their wealth is held in cryptocurrency, traditional avenues become less accessible. The rise of cryptocurrency millionaires is significant. In a recent survey, it was revealed that the global count of such individuals reached 241,700 in 2025, marking a 40% increase from the previous year. So how do these affluent cryptocurrency holders leverage their wealth for an opulent lifestyle? Traditional banks typically shy away from cryptocurrency dealings, and selling their digital assets is often not an option. Where then do they turn? Enter the realm of sophisticated decentralized finance lending strategies. Jérôme de Tiché, the founder of Cometh, a DeFi for businesses facilitator recently licensed under markets in crypto assets in France, explains the approach. For those deeply versed in cryptocurrency, converting their Ether tokens into stablecoins through platforms like Aave is straightforward. However, for those whose fortunes grew merely by holding crypto, the decentralized finance process can seem daunting. This complexity is precisely where we step in to assist family offices, which often hold substantial crypto and seek credit lines. Taichi shared during an interview at the CFC St. Moritz Crypto Conference. Wealthy clients frequently utilize collateral loans, known as Lombard loans, to secure funds against assets like stocks and bonds. These short-term loans allow access to cash without liquidating investments, thus avoiding capital gains tax and retaining benefits like dividends. Typically holding wealth in the tens or hundreds of millions, these clients aim to maintain asset stability while financing their lifestyles at minimal cost. Yatiki's enterprise incorporated a decentralized finance element, potentially involving Bitcoin on Aave or providing liquidity on platforms like Uniswap Banja. Crypto-backed borrowing offers benefits such as rapid processing times. Loans secured by Bitcoin can be completed in as little as 30 seconds, compared to up to 7 days for traditional Lombard loans at private banks. Moreover, traditional loans demand credit checks and tax returns, while decentralized finance loans operate on a permissionless basis, offering anonymity for privacy seekers. Nonetheless, crypto loans entail counterparty risks and volatility, as a sudden drop in asset value could trigger automatic collateral liquidation by smart contract. Ultimately, the process facilitates using crypto assets for quicker, more efficient loan acquisition, bypassing conventional banks that might not recognize crypto as viable collateral. With a newly acquired MiCA license in France, Cometh is exploring decentralized finance strategies for stocks, bonds, and derivatives using international securities identification numbers. For instance, accessing debt through Tesla share accounts necessitates ISIN-based codes held in dedicated funds, as the Taifi explains. We are pioneering these methods via private debt products accessible to anyone with a title account. It is a reverse approach to tokenization, a tradfication of decentralized finance. The Taifi elaborated. As we witness this transformational shift, we must ponder: are we ready to embrace a financial landscape where decentralized systems redefine wealth management? Share your thoughts and join the discussion in the chat. Bitcoin's role as a safe haven under scrutiny. Bitcoin is acting as a quick cash source rather than a refuge during turbulent times. In the unfolding drama of global uncertainty, Bitcoin, often heralded as a bastion of financial resilience, is revealing a different character. Instead of standing firm as a safe haven, it is swiftly being liquidated by investors seeking immediate liquidity. Recent geopolitical tensions, exacerbated by discussions of tariffs and military maneuvers involving Greenland, have led to significant market fluctuations. In the wake of such upheaval, Bitcoin has seen a decline of 6.6% since January 18th, contrasting sharply with gold's rise of 8.6%, reaching new heights near $5,000. The essence of this conundrum lies in the nature of these assets during economic stress. Bitcoin's seamless trading and high liquidity make it an attractive option for investors needing to rapidly convert assets into cash. Meanwhile, gold, despite its less accessible nature, remains a stalwart holding, often retained rather than sold. This behavior has led Bitcoin to be perceived as more of a quick cash machine during financial turmoil, casting doubt on its status as digital gold. Liquidity preference seems to overshadow Bitcoin's potential benefits under stress, marking it as more volatile and readily sold compared to gold, which continues to serve as a solid liquidity anchor. The dynamics are further complicated by the actions of large holders. Central banks are accumulating gold at unprecedented levels, reinforcing its demand. Conversely, long-term Bitcoin holders are reportedly offloading their assets, as evidenced by on-chain data, indicating a movement of older coins to exchanges, contributing to a persistent selling trend. The disparity extends to how risk is assessed in the current climate. The volatility is deemed episodic, driven by political maneuvers and economic threats. Gold, historically a hedge against such uncertainties, maintains its role. Bitcoin appears more aligned with long-term financial and geopolitical instability, which unfolds over extended periods rather than immediate crises. Thus, as markets grapple with present dangers perceived as significant but not yet systemic, gold continues to be the preferred safeguard. As we ponder the future of financial refuges, the question arises: can Bitcoin evolve to fulfill its promise as a true safe haven? Or will it remain a transient refuge in times of immediate need? Share your thoughts and insights in the chat. Bitcoin's timeless dilemma. Where is the real value? Bitcoin's narrative faces scrutiny as traditional assets outperform, challenging the digital currency's perceived roles. The once vaunted narratives surrounding Bitcoin have come under scrutiny as the digital currency struggles to fulfill its perceived roles as an inflation hedge and a safe haven during uncertainty. In contrast, gold has surged by more than 80% in the face of high inflation, geopolitical tensions, and interest rate fluctuations, while Bitcoin has seen a 14% decline year over year. The expectation that inflation-protective assets should appreciate when monetary value diminishes has held true for gold and other precious metals. However, this theory has not translated to what some call digital gold. Such a divergence in performance raises pertinent questions. Why should one invest in Bitcoin now when traditional assets and equities offer superior returns? As we ponder the underlying dynamics, we observe a world where individual choices and subjective valuations shape markets. The decentralized nature of Bitcoin should, in theory, align with the principles of a free market, where value emerges from the voluntary interactions of countless individuals. Yet, external impositions and artificial constraints, whether through regulatory measures or market sentiment, may impede its full potential. The situation invites us to reflect on the essence of value and the mechanisms that drive market processes. Are we witnessing a transient phase in Bitcoin's journey, or does it signal a deeper misalignment between expectations and market realities? How does the decentralized knowledge within the market reconcile with such fluctuations? We invite you to delve deeper into these questions and share your insights. What do you believe is the future of Bitcoin within this complex market landscape? Join the discussion and share your thoughts in the chat. GameStop's bold Bitcoin shift spurs market buzz. GameStop's substantial Bitcoin movement to Coinbase Prime ignites curiosity around potential selling intentions, underscoring market pressures. The recent transfer of a significant Bitcoin reserve by GameStop to Coinbase Prime has sparked widespread speculation regarding the company's intentions. A wallet associated with GameStop moved approximately 4,710 Bitcoin, valued at an estimated $420 million, to Coinbase's institutional platform. According to blockchain insights from CryptoQuant and verified by Arkham Intelligence, GameStop initially announced its Bitcoin acquisition in May, with estimates suggesting an investment of roughly $504 million at an average acquisition price of $107,900 per Bitcoin. At current values near $89,000 per Bitcoin, a sale would likely result in a loss of about $84 million. This strategic move has fueled speculation that GameStop may be reconsidering its position in Bitcoin, particularly in light of the recent downturn in crypto markets, which has left many digital asset treasuries grappling with potential losses. Other firms, such as Ethereum-focused Ethila, have already offloaded portions of their holdings to mitigate debt, while transferring assets to Coinbase Prime, a platform known for serving institutional clients, often suggests an intention to sell. It does not definitively indicate an impending liquidation. Coinbase Prime also offers custodial services, which could imply internal management rather than outright sale. GameStop has yet to issue a statement regarding this transfer. Reflecting on this development, we must consider the broader implications of such strategic maneuvers by influential firms within the crypto space. The dynamics of digital asset management are intricate, with decentralized knowledge and subjective valuations guiding decisions under uncertainty. As we observe these market shifts, one must ask, how does the interplay of individual choices and market pressures shape the trajectory of digital assets? Join the discussion in the chat and share your thoughts on the potential impact of GameStop's decision. Thank you so much for following BlockSonic today. See you soon with more news, analysis, and market alerts. Keep an eye on Bitcoin and continue listening to the sound of the blockchain.